Hi everyone, this is Ross Healy, the Chairman of Strategic Analysis Corporation and the Portfolio Manager at McNichol & Associates Asset Management. Welcome back to FANG Friday. Well, before I get into looking at the FANGs, I'd like to respond to one of our viewers who asked me, how is it that how do we calculate the fair market value for the Standard & Poor's 500, which, as you will remember, stands currently today at about 3150. Well, the answer is both simple and complicated. First off, we assemble the earnings forecasts from the roughly 10,000 analysts or so who cover the Standard & Poor's 500 stocks. Not, of course, 10,000 following each stock, but probably on average following the 500 stocks. And we assemble a consensus earnings forecast then for each of the company 1 year out. And then we add up those consensus numbers, and what we do is we take a capitalization weighted average. What we do is we compare the earnings forecast 1 year out, and we compare that to the company's basic cost of capital. So the fair market value numbers are not based on current earnings, because that's already in the market. Our numbers look 1 year out, but we don't do any forecasting ourselves. Okay. If you don't like our numbers, well, you're going to have to blame it on the 10,000 analysts who actually made them, and which we gathered up. We just do the arithmetic. Now, the actual math that we use to calculate that fair market value is derived from the mathematics in Dr. Vern Attrell's book, How All Economies Work. And basically, it's kind of similar to both mathematically and statistically to the theorem of the limit. And so far, it has proven to be a limit, at least based on the past 35 years of data that we have. Anyway, moving on to FANG stocks, but before I leave that idea of the theorem of the limit, many senior stocks, both in Canada and the United States, tend to peak out right at their own fair market value. And BCE was one which did so with absolute dead precision. And it did that twice. After struggling mightily to go any further, it finally said, nuts, and kind of gave up. But it dropped to another break point, gave us a perfect buy signal. And we've been holding that stock in our model portfolio. And personally, the stock is coming up to its fair market value again. That value precisely is $68.92. If BCE gets anywhere close to that number, then we're going to take our profits on this company. However, that is for most senior stocks. For hyper growth stocks like the FANGs, as we can see just looking at Apple here, at Amazon, we can see that the stock gets way above its fair market value from time to time. I believe I showed you a chart of Amazon going back to I think to the year 2000, and I showed you that from time to time that Amazon comes down to its fair market value, and you kind of want to avoid those kinds of pitfalls, because look here, the fair market value is 72.66% lower than the price is at the present time. Anyway, that's then. This is now. Looking at Amazon, we can see the stock kind of drifting lower below its HB3, which is 16 times book value, and I think it wants to head down to its HB2, which is 12 times book value. And today that number stands at about, well, precisely actually 1536. Last week I discussed a number of the FANG stocks, FANGs and related stocks, which are coming up hard against their own fair market value and indeed technical resistance level. And let's go and see what they did in the past week. Starting with Facebook. Its targeted price here, the MSG price, or 5.5 times book value. The stock remains right in there. It's struggling to get through, but so far has been unable to do so. Netflix. A very interesting company here because it's already had a 2 breakpoint fall, and it's struggling mightily against its HB3, trying to break out again. Today, actually, the stock popped above that breakpoint value, up some $5, kind of like it did a few weeks ago back here. I think that it probably did that on the kind of on the coattails of Disney. Disney had not terribly good numbers, that's for sure, when they reported, but nonetheless, this is the kind of market that says if it's bad news, it's got to be good, and Disney has popped out over its mid-growth price, which is only 2.5 times book value. You can see that's an awful lot less expensive than Netflix, but Disney has popped out over that breakpoint, and it very much appears as if Netflix kind of wants to go with Disney, but we'll have to see. Microsoft, well, we've looked at Microsoft before, and we can see that it remains hard up against its HB1 price. That is 10 times roughly its book value. And of course, going back in history, looking at this 20-year chart of Disney, of Microsoft rather, you can see that the last time that the stock was this high was way back at the peak of 2008. Interestingly enough, by the way, if you go back to 2000, here is Microsoft peaking out at its bubble price. That's 7.4 times book value. It actually hit its peak at the crest of the market in 1998, not at the peak of the market in 2000. Anyway, that stock is trying mightily to break out as well. Alphabet, well, I'm kind of sorry actually we missed the bounce in Alphabet, although our position on the company was way back in March when we started, was as a sell a void in the company, and so far the looking at what the market has done between then and now, point over point we've done all right, except that there was a nice trading opportunity in between. Well, we were kind of greedy. We wanted to buy it at the super growth price. We didn't, and the stock has bounced, but you can't win them all. Here's Nvidia, and here's an interesting stock. Certainly the stock wants to wants to go higher, and yet when you look at the numbers from the industry, it's in just a frightful slump. However, that hasn't stopped Nvidia from going higher. It hasn't stopped Applied Materials from having a beautiful jump today. And so, as I said, what's these days, what's bad is good. Now, Apple here is, if you like, one of the shortcomings of SVA, and that is to say that we wait for balance sheets to confirm. And remember, I said last week when I showed you that Apple was trading hard up against its HB1 price, I said, look, I know that they have been buying back stock, and it depends how much they have bought back, how far that the balance sheet itself will fall, and therefore whether the stock actually will have proven to have broken out over its HB1 price. And in retrospect, with the new balance sheet, which I've got shown up here in the corner, that has exactly proved to be the case. However, do I feel apologetic about that? Well, let's take a look at the 10-year view of Apple, and you can see from a very long-term point of view that company is right up. It's very, very expensive. In fact, it's well over its fair market value, and it may go higher. It may go up actually to its HB2, which is $303. But my goodness, the riskiness of this investment is growing by leaps and bounds. Anyway, that's all for our FANGs today, except to leave you with a thought, and that's to say, what's ahead? Well, we know, looking at that the stocks that Netflix, Microsoft, Facebook, and maybe Alphabet for that matter, which is also up against some resistance, maybe they all want to break out and run, but the market is going to have to break out for it, and it's not that it's impossible. I won't say that, but what I will say is that mathematically and statistically it appears to be improbable. However, this is going to be a story for another day, and as we are right up very, very close to that value for the Standard & Poor's 500, it's going to be an interesting week or so ahead of us. In the meantime, this is Ross Healy, the chairman of Strategic Analysis Corporation and a portfolio manager for McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week. Have a good one.